Internal Revenue Service IRS tax news. Relief for taxpayers affected by COVID-19 who take distributions or loans from retirement plans. IR 2020-124, June 19th, 2020. Washington. The Internal Revenue Service today released Notice 2020-50. There's a PDF link to that here. There'll be a link to this in the description. To help retirement plan participants affected by the COVID-19 coronavirus take advantage of CARES Act provisions, providing enhanced access to plan distributions and plan loans. This includes expanding the categories of individuals eligible for these types of distributions and loans, referred to as qualified individuals, and providing helpful guidance and examples on how qualified individuals would reflect the tax treatment of these distributions and loans on their federal income taxes. So in other words, when we look into these types of retirement plans, oftentimes, of course, the reason we put money into some type of retirement plan is because we get a tax break, typically on the front end if it's going to be a normal type of retirement plan. So the IRS is giving us an incentive to put us money into the retirement plan, although, however, they also penalize us if we take our own money then back out of the retirement plan, in part that penalty typically being the fact that we have to pay taxes on it if it was not taxed when we first put it into the retirement plan, and we could have a penalty on top of that as well to take it out. So if you're in an emergency situation, then you'd like to say, hey, look, I don't have any money right now because it's an emergency. Is there any way, that I could take money out of the retirement plan without having these added penalties possibly take a loan against it in some way so I can get money now without being penalized by the IRS for it. So that's kind of an overview of the thinking that would be going on here. So if you do have some type of retirement plan, then you might be thinking, hey, can I tap into that somehow without causing the problems? And again, what other problems typically? Well, that money's restricted because you put it in there and you probably got a tax break for it. And therefore, you can only take it out under certain conditions in order to not have the penalties that would be included on it. And so hopefully the IRS could expand those given the circumstances at this point. Back to the text. The CARES Act provides that qualified individuals may treat as coronavirus-related distributions up to $100,000 in distributions made from their eligible retirement plans, including IRAs. So if you don't have an employer plan like a 401k plan, then you might put money into an IRA. And so that's going to qualify too. They're all usually kind of similar in that they're giving you that tax break, right? You're putting money in there in order to get the tax break, and then the money's restricted. If you take it out the IRS, then you have problems with it. But so you want to be under the umbrella to be able to take something else out without the penalty being applied. Back to the text. Between January 1st and December 30th, 2020, a coronavirus-related distribution is not subject to the 10% additional tax that otherwise generally applies to distributions made before an individual reaches age 59 and a half. So obviously the goal of the retirement plan is to put the money in there until retirement. So if you took it out after retirement, you wouldn't be subject to the penalty. If you take it out before and you're not under one of these types of things that could not allow you to get away of taking the money out without being penalized, then you'll have that 10% penalty. So the idea here is to waive that 10% penalty in the case. So in addition to coronavirus-related distributions can be included in income in equal installments over a 3-year period, and an individual has 3 years to repay a coronavirus-related distribution to a plan or IRA and undo the tax consequences of the distribution. So in other words, you might think, well, if I take the money out and I'm not going to be penalized at that 10%, well, then I'm home free. That's fine. I'm good. But that's not totally the case, because when you take the money out, because you were not taxed on it when you put it in there, it's basically a deferral usually when you're talking about a normal retirement plan, normal IRA, rather than like a Roth type of situation. Because you weren't taxed on it when you put it in there, you're taxed on it when you take it out. So it's basically kind of a tax deferral thing. So normally, if you take the money out early, you are subject to a 10% penalty, and you have to pay tax on it as if it was earned income, basically in the current time period. So now they're going to waive the penalty, but you still would then have this income that would be on your books, basically on your tax return, increasing the tax due to the fact of taking it out. So this is related to that second component that could have a tax effect. So let's read that again. In addition to coronavirus related distributions can be included in income in equal installments over a 3-year period. So if you need the money now, if there's some crisis that happened now and you took $100,000 out of it, then that would increase your income substantially, put you in a higher tax bracket right now. So the IRS is basically, possibly you might be able to say, okay, well, maybe I can take that 100,000 out and then pay it back in installments, and possibly then that would increase the income in increments that wouldn't kick you into some really high tax bracket at the point in time you took it out. So you want to get tax advice on that whenever you think about taking money. Anytime you take money out of a retirement plan. But keep that in mind, keep these rules in mind. And an individual has 3 years to repay a coronavirus-related distribution to a plan or IRA to undo the tax effect. So then basically what I'm interpreting that to say is if you put the money back in, then you kind of like undo it. So meaning you may not have to put it in the income possibly at that point in time and pay the income taxes, basically just putting it back into the retirement plan, so that you can then, just move forward without having either hopefully the penalty or paying the tax upon the distribution of it. Now, of course, obviously, when you put the money back in, what you want to do is put more money into the IRA because you get a tax break, on when you put the money into the IRA. So if you were to replace the money that you took out, then the concept would be that you wouldn't have the tax effect of it being taken out. So in any case, back to the text. In addition, the CARES Act provides that plans may implement certain relaxed rules for qualified individuals relating to plan amounts and repayment terms. In particular, plans may suspend loan repayments that are due from March 27th through December 31st, 2020, and the dollar limit on loans made between March 27th and September 22nd, 2020 is raised from $50,000 to $100,000. So normally, just to put some interpretation on here, oftentimes when you put money into an IRA, you're saying, I'm going to put money into an IRA right now because I want the tax break. But then you might say, well, I need the money. I'd like the money, but I want to put it into the IRA to get the tax break. And then the next thing that would pop into someone's mind possibly would say, well, I could put money into the IRA or the retirement plan or whatever. I could put money in there, and then I could take a loan against that money, basically using it, as collateral. I could loan myself the money back out, right, in essence, or take a loan against it in some way, which the IRS doesn't typically like, right? Because then it kind of defeats the point, because you put money into an IRA, but then you took on a liability for it. So typically, that's not something, that they typically allow, even though the government does it all, that they basically do that with Social Security. But anyway, you're not supposed to do that because that kind of defeats the point. So, but now they may loosen the restrictions on that. So that would be possibly another option to think about the loans. Let's read that one more time. In addition, the CARES Act provides that plan may implement certain relaxed rules for qualified individuals relating to planned loan amounts and repayment terms. In particular, plans may suspend loan repayments that are due from March 27th through December 31st, and the dollar limit on loans made between March 27th and September 27th and September 22nd, 2020 is raised from $50,000 to $100,000. As authorized under the CARES Act, Notice 2020-50 expands the definition of who is a qualified individual to take into account additional factors such as reductions in pay, recessions of job offers, and delayed start dates with respect to an individual, as well as adverse financial consequences to an individual arising from impact of the COVID-19 coronavirus on individual spouse or household member. As expanded under Notice 2020-50, a qualified individual is anyone who is diagnosed or whose spouse or dependent is diagnosed with the coronavirus SARS-CoV-2 or the coronavirus disease 2019, collectively COVID-19, by a test approved by the Centers of Disease Control and Prevention, including a test authorized under the Federal Food, Drug, and Cosmetic Act. So hopefully they're getting these tests more standardized, so you want to make sure that you get the tests from whatever the qualifying test would be for this. Back to the text. Experiences adverse financial consequences as a result of the individual spouse, or a member of the individual's household, that is, someone who shares the individual's principal residence, being quarantined, being furloughed or laid off, or having work hours reduced due to COVID-19, being unable to work due to lack of childcare due to COVID-19, closing or reducing hours of a business that they own or operate due to COVID-19, having pay or self-employment income reduced due to COVID-19, or having a job offer rescinded or start date for a job delayed due to COVID-19. Notice 2020-50 clarifies that employers can choose whether to implement these coronavirus-related distribution and loan rules, and notes that qualified individuals can claim the tax benefits of coronavirus-related distribution rules even if plan provisions aren't changed. The guidance clarifies that administrators can rely on individual certification that the individual is a qualified individual, and provides a sample certification, but also notes that an individual must actually be a qualified individual in order to obtain favorable tax treatment. Further, Notice 2020-50 provides employers a safe harbor procedure for implementing the suspension of loan repayments otherwise due through the end of 2020, but notes that there may be other reasonable ways to administer these rules. Employers, financial institutions, and individuals should refer to Notice 2020-50 for more details about how the CARES Act rules for coronavirus-related distributions and loans from plans apply. These tax relief and other information related to the effects of coronavirus on federal income tax is available on the IRS Corona Tax Relief page of the IRS.gov website. There's a link to that here. There'll be a link to this in the description.